Well, the law of gravity hit Wall Street today and financial markets around the world, for that matter, as stock prices plunged even more than they did on Black Tuesday of 1929.
It was a day that began like any other, but by the time the closing bell rang, Wall Street had plunged into chaos. October 19, 1987 saw a market collapse so sudden and catastrophic that no one saw it coming. What triggered this financial disaster? In this video, we'll discuss the events that led to this unprecedented crash and examine how it reshaped the financial world. Background and lead up to Black Monday. Before the crash, the stock market was on an extraordinary run. From 1982 to 1987, the market experienced a powerful bull run, with stock prices more than tripling in just 5 years. Investors were riding high on this wave of optimism, and it seemed like the good times would never end. The S&P 500 had climbed by an astounding 44% in 1987 alone, and Wall Street was buzzing with confidence. But, as we know, what goes up must come down. In the days leading up to October 19, 1987, there were signs that all was not well. Just a week before, the market began to show cracks. On October 14, the Dow Jones Industrial Average saw a sharp decline of nearly 4%. The next day, it dropped another 2.5%. Then on Friday, October 16, London markets suffered a devastating 5% loss, coinciding with the Great Storm of 1987, a rare and deadly weather event that added to the sense of impending doom. Investors were becoming increasingly nervous, and the market's once steady climb now seemed fragile. Economic concerns were also beginning to weigh heavily on the market. The economy was slowing, inflation was creeping up, and trade deficits were widening. These factors contributed to a growing sense of unease among investors who feared that the bull market was running out of steam. As the market stumbled in the days leading up to Black Monday, these economic worries only added fuel to the fire. Investors were jittery, and the stage was set for what would become the most infamous crash in stock market history. The events of Black Monday. It began with an unsettling silence, quickly shattered by chaos. As the first trades of October 19, 1987 were executed in Hong Kong, the market took a sharp downturn, setting off alarm bells across financial centers worldwide. This initial drop spread like wildfire through Asia, causing a wave of panic that rolled across the continent. By the time European markets opened, the damage was already evident. London, Paris, and Frankfurt saw their stock markets tumble under the weight of a global financial panic. When the US markets finally opened, the full extent of the turmoil became starkly apparent. The Dow Jones Industrial Average, a key indicator of the American economy, saw an astonishing drop of over 500 points, translating to a nearly 23% decline in one day. This massive plunge was the steepest ever recorded, outstripping even the dramatic falls seen during the 1929 crash. Similarly, the S&P 500 index plummeted by more than 20%, a loss of nearly 55 points. The scale of the decline was so severe that it seemed almost beyond comprehension. The trading floors in New York were engulfed in pandemonium. What had been a bustling center of commerce was transformed into a scene of frantic activity and sheer panic. Traders, overwhelmed by the torrent of sell orders, struggled to keep pace. The once orderly process of buying and selling turned into a chaotic scramble as investors desperately tried to exit their positions. The feedback loop created by computerized trading systems and portfolio insurance strategies only compounded the problem, triggering more selling and driving the market further down. By the close of the day, the financial landscape had changed irreversibly, marking Black Monday as a day of unprecedented market turmoil and fear. Causes of the crash. In the whirlwind of October 19, 1987, the crash did not merely happen. It was driven by a series of factors that combined to create a perfect storm. At the heart of the chaos were newly introduced computerized trading systems, which had transformed the way transactions were executed on Wall Street. These systems, designed to handle large volumes of trades with speed and precision, inadvertently fueled the panic. As stock prices began to fall, automated trading algorithms reacted swiftly, triggering a cascade of sell orders. This rapid-fire selling intensified the market's decline, creating a vicious cycle that accelerated the drop further. Adding to the turmoil was the rise of portfolio insurance, a strategy that had been gaining popularity in the years leading up to the crash. Portfolio insurance was intended to protect investors from losses by using complex financial instruments to hedge against market downturns. In theory, it was a sound idea: sell futures contracts to offset potential losses. However, when the market started to decline, these strategies required more selling to maintain the protective hedges. This led to a feedback loop. As prices fell, more futures were sold, which drove prices down even further, causing more selling. This cycle only deepened the crash, amplifying the market's freefall. The crash was not solely the result of trading strategies gone awry. Years of bullish optimism had led to an overvaluation of stocks. By 1987, stock prices had skyrocketed, tripling since the early 1980s. This dramatic rise in valuations had made the market ripe for a significant correction. Investors were already jittery, and the market was primed for a dramatic downturn. Additionally, external economic factors added to the volatility. Rising oil prices, fluctuating interest rates, and concerns over trade deficits had been creating unease among investors. These elements combined with the internal mechanics of trading strategies to produce a situation where a small disturbance could trigger a massive collapse. Together, these factors created a volatile mix that made Black Monday not just a day of market upheaval, but a stark reminder of how interconnected and sensitive financial systems can be. Immediate aftermath and recovery. The aftermath of Black Monday was as dramatic as the crash itself. As the dust settled from the chaos, something remarkable happened. Within just a few days of the crash, the stock market began to rebound with surprising speed. The Dow Jones Industrial Average, which had suffered a staggering drop, regained nearly 60% of its losses within a remarkably short period. This swift recovery caught many by surprise and hinted at the market's underlying strength. For investors, the immediate impact of the crash was profound and varied. Institutional investors, such as large banks and investment firms, were hit hard by the rapid declines but had the resources and strategies to weather the storm. These institutions faced significant losses but could manage through their diversified portfolios and risk management strategies. On the other hand, individual or retail investors often found themselves more vulnerable. Many had invested heavily during the bull market and faced significant financial strain. The panic selling and subsequent market volatility led to a sense of fear and uncertainty among these smaller investors. Despite the initial turmoil, the long-term resilience of the market became evident. The crash did not spell the end of the bull market. Instead, it marked a brief interruption in a period of sustained growth. Throughout the 1990s, the market rebounded strongly and entered another extended bull market. The recovery from Black Monday demonstrated the resilience of the financial system and reinforced the importance of long-term investment strategies. Despite the severe short-term impact, the market's ability to recover and thrive highlighted the fundamental strength of the economy and the enduring nature of investment opportunities. Lessons learned and changes implemented. The shockwaves from Black Monday led to significant changes in the financial world, driven by the urgent need to prevent a repeat of such a dramatic event. In response to the crash, stock exchanges worldwide introduced a system known as circuit breakers. These are designed to temporarily halt trading when major indices fall by a certain percentage. The goal is to prevent a market panic from escalating uncontrollably. For instance, if the S&P 500 index drops by more than 7% in a single day, trading is paused for 15 minutes to give investors time to reassess their strategies. This measure was a direct reaction to the chaos of Black Monday, aiming to stabilize the market and restore order during periods of extreme volatility. Following the crash, trading strategies underwent a profound transformation. The evolution of trading strategies saw a shift towards more sophisticated risk management techniques. Investors and institutions moved away from relying solely on automated systems and began incorporating more comprehensive risk assessments. The focus shifted to creating systems that could handle market volatility without exacerbating it. This change was crucial in helping to prevent future crashes of similar magnitude. Investor psychology also came under scrutiny after Black Monday. The crash revealed how quickly panic can spread among investors, leading to widespread sell-offs and market instability. The event highlighted the dangers of allowing fear to drive investment decisions. Since then, there has been a greater emphasis on understanding investor behavior and promoting strategies that can help mitigate the impact of emotional reactions on market movements. This shift in focus has been instrumental in building a more resilient financial system, one that is better equipped to handle the uncertainties and pressures of global markets. The ripple effects of Black Monday still influence trading strategies today. But do you think the market has learned its lesson, or are we still vulnerable to another catastrophic crash? Drop your opinions in the comments, subscribe for more financial history.